In the investment arena, the financial companies, they play both sides. They say the market's going up, the market's going down, and the people that get the press are the ones that are right. The sporting industry does the same thing. This was the Super Bowl. Why the Patriots will win the Super Bowl, why the Falcons will win the Super Bowl. And they both state good cases, right? And if you're a Falcons fan, you'll gravitate towards this one. If you're a Patriots fan, you'll gravitate towards that one. Right? The financial industry does the same thing. So every year for this class, I go out and I get the case for and the case against, and you can do that. And if you're feeling, like the market's going to go down, you're going to go out and search for the case against, and then you're going to believe all the things that that guy says. And if you're feeling like the market's going to go up, you're going to search for the case for, and you're going to believe all the stuff that that guy says. If you're prudently invested, you should probably ignore both of them. And this kind of proves why. But this is in Barron's magazine. This was December 17th, 2016. Outlook 2017. This bull market has legs. Wall Street's top strategists see stocks rising 5% next year after 2016's thunderous post-election rally. So we're already up almost, 4 to 5%. So, hopefully we get at least that much by the end of the year, but nobody knows until the end of the year. So this was their case for positive returns in the equity markets. Enthusiasm for Trump's expected pro-growth agenda. There's tax cuts coming, higher than expected corporate earnings, and new infrastructure spending. Then we have the case for the Trump bear market. This was November 13th, 2016. It was just a couple of days ago that we wrote our case for a Trump bull market. So these guys are covering their bases on their own website, right? Case for and a case against on their website. So we have been bearish on the market the last year and continue to believe that we see a strong correction in the days ahead. Did that correction ever happen? No, not so far. Not so far. So here was their case for negative returns. The market, we believe, is significantly overvalued. The debt cycle is turning over. There is uncertainty ahead with the volatility associated with Donald Trump. A rise in interest rates could catalyze delinquencies on subprime debt. Deregulation would make problems worse. And then their little footnote at the bottom, we were wrong about the direction of the market last year and are prepared to be proven wrong again by Mr. Trump. Okay, so they're covering their bases. Now, if the market goes up, they will go to that other article, the case for, and they will say, I told you so. If the market goes down, they will go to the article that they wrote, the case for, the case against, and they will say, I told you so. You have to be careful of that. Investors know, wise investors know that there's infinite possibilities. You want a prediction from me? You guys know what's coming? Things will change for reasons unknown to us at the present time. Okay, you can count on it. 2016 was no different, right? All these unpredictable variables. We covered this in the last class. The January-February crash. City, the world economy is trapped in a death spiral, right? And then in the middle of the year, we had Brexit and the market crashing for, what, 2 days? It's supposed to crash for a long time. And then, of course, the presidential election. All those things caused investors to panic last year. Now, every year, Barron's publishes the forecasts from the experts. So I get it every year and share it in class. And this is their forecast, and this is the market. And then you see their forecasts from the experts are all over the place. Now you have forecasts from the expert, the money managers and that kind of thing. And then you have forecasts from the fear mongers. Two different kind of people. The forecast from the money managers, the experts, they never predict a negative year. Ever. I've never seen it. So here, negative year, that's their projections. Negative year, that's their projections. Negative year, that was their projection. Big negative year, right, in the financial crisis, that was their projection. A little negative year, that was their projection. They're always saying the market, because they have an agenda, right? They want everybody to be invested. So the fear mongers are always saying what? It's always going down, no matter what. And then we have a down market, and then they say, I told you so. I was just early the last time. So here's why forecasting is for dummies.
The fifth commandment of investor behavior is that forecasting is for weathermen. J.P. Morgan was famously asked what he thought the market would do in the future, and he simply said, it will fluctuate. And he was right. Philip Tetlock of UCLA is the foremost expert in analyzing forecasts and found two things: that the more dramatic the past forecast, the more error-filled future forecasts were likely to be, and also found that the more famous the expert, the worse their forecast turned out to be. David Dreeman, the famous contrarian, looked at 78,000 data points and found that only one time in 170 are market analysts even within 5% of the correct answer. And yet we find that when average people listen to expert forecasts, it actually puts to sleep the part of their brain involved in critical thinking. Trust me, I'm a doctor.
Well, you guys saw it on the chart, but one time in 170 are they within 5% of the actual forecast. That should tell you something.